What's our opinion of gold? Its price has risen recently. What's the right time to own gold?
Well, you're right, Jessica. I mean, gold has seen some significant gains here more recently. And you really got to take yourself all the way back to 2011 for the last time you'd seen gold run up similar to what it's doing here today. And that's not too terribly unusual. I mean, one of the features that we've noticed about gold is it tends to go in these fits and starts. You have these very short periods of time where it does very, very well, but then even these much longer periods of time where it really doesn't do much of anything. And as you think back to 2011, I mean, at that point in time, gold did well, tied to the fears of the so-called pigs, and the increasing levels of debt and whether or not that would create an unraveling of the euro. Whereas today, we can debate some of the reasons why gold has done so well. Maybe it's a safe haven in this global pandemic. Maybe it's a hedge against a dollar devaluation or a hedge on inflation, or even on the flip side, I've heard it being a hedge on deflation. um, you name it, if you're a gold bug, you can find any reason to really justify your bullishness on the metal. But, for our part, as we think about gold relative to owning stocks, bonds, or any other asset class for that matter, I mean, if you think about all the reasons why you would want to own a stock, they're not really relevant to gold. So, for instance, gold doesn't generate earnings, it doesn't kick off dividends. And in fact, when you look over longer periods of time, the returns of gold lags both that of stocks and bonds, and it in fact exhibits higher levels of volatility. So, as we think about building a globally diversified portfolio for our clients, we feel we can do so in such a way that includes stocks, bonds, cash, um, and deliver on our clients' financial goals and objectives, and in that manner, without having to really resort to owning gold. So gold's had a nice run here, but some of the characteristics for us are unappealing relative to other asset classes.
Are rising sovereign debt levels in the US and globally a concern for us?
Boy, next to politics, there's probably nothing that gets people as incensed as talking about government debt and so forth, particularly in a period like this where deficits are huge, debt's been rising in an absolute sense relative to GDP, which I think of course, has a lot of people having debt on their minds. And it's a big topic that you can approach in a lot of different ways. And we've done that actually. We've written extensively on government debt and its impact on markets. Ken's written that in a number of his books. But for the purposes of our conversation here, I'll simply say, no, government debt levels aren't something that we're worried about at present. And I think the easiest way to look at that right now is to say, going back to something we mentioned before, that stocks look out a few months to a few years into the future. What's the likelihood that we get to levels of government debt that really become problematic for the economy and might actually have some feedback into equities? And we feel very, very confident that we're not anywhere near those types of levels right now. Doesn't mean you can go on accumulating debt forever, but I think the chances of the US or other major developed countries in the world turning into an Argentina, for instance, here in any time soon, that's a very, very low likelihood. And you can see that in a few ways. One, if you just think about the interest rate environment today, what governments are paying for the debt they're issuing, it's as low as it's ever been in most parts of the developed world. You've got negative interest rates all along the yield curve in places like Europe, basically zero interest rates across Japan. Here in the US, we've got record low interest rates. So the market is certainly telling you that they're not overly concerned about government's ability to pay debt. And because those interest rates are so low, the burden of that debt is a lot lower than it might be otherwise. In other words, the interest that we're paying on the debt relative to our tax receipts, relative to the size of the economy, really isn't all that huge. We've dealt with much higher levels of interest burden historically, and it hasn't been economically problematic. So no real reason to think it will be here in the immediate term.
Will these extraordinary fiscal and monetary policies lead to inflation? And if so, what will that mean for stocks?
Well, I think people are going to be discussing inflation for a long time to come, and I imagine we'll be fielding questions about it for a similar amount of time. But in fact, in the current moment, inflation is not something that should have your full attention. So let me just explain a little bit about how to think about inflation relative to your investments, and then I'll talk a little more fundamentally. First, with a portfolio, a little bit of inflation is an okay thing. The dangerous part, and the part that people get in their minds, which is much less common and much less likely at the moment, is high inflation. High inflation to the point where it's really galloping past the real rate of growth. That's just not really on the table today. It's not impossible, but it's not on the table. And what people, I think, might be mistaking some of their fears for at the moment is the notion of just resuming a relatively normal level of inflation that we had, let's say, pre the COVID crisis and tragedy, and we're just sort of getting back up to those levels. That's a very different thing than saying inflation is about to be very structurally high. So I just want to make that point because in portfolio management, you don't necessarily want to make moves before you really need to. This is a classic case of that. If you anticipate inflation too early, you could be very wrong and end up with a set of things that don't do much for you at all. And so we want to be very careful about that. Now, speaking about inflation in a fundamental sense, it is true the money supply has grown very big and very rapidly in this country, but also in other countries in the last several months. In this country, what we've effectively done is issued a bunch of T-bills in the form of debt and then put that into the pockets of people in their checking accounts. That's different than prior periods where, we were very critical of things like quantitative easing because it never really got money into the economy. This seems to be different, except there are a couple things. First, and I mentioned this earlier in an earlier question, savings rate is actually higher today than it was several months ago, which means, yes, some of that new money is hitting the pocketbooks of people, but by the same token, they're not necessarily spending all that at once. They have it there. They might spend it, but we'll see how that goes. But the idea that they just all that stimulus money is just about to hit like a wall in the economy is not quite happening in the same way people might expect. And that gets me to the second point, which is the velocity of money. Now, when you listen to us speak about inflation, we talk about the overall quantity of money a lot as one of the drivers of inflation, and that's very true. I believe in that. But you also need to look at the velocity. Over the last 40 years, velocity has been kind of on a trail down, and in the last several months, it's really come down more. Well, velocity is just how many times money moves through a system, let's say, per year. And on average, it's been known to do about money exchanges hands about 6 times per year or so on average. But today, that's much lower. That's important for inflation because in order to get the inflation, the money needs to really be moving through the system. You need to pay the producer, and the producer needs to pay the supplier, and on and on. And in fact, that goes in and out of banks quite a lot as you do that. The money needs to round trip before prices can really start to spiral. We're not even in that beginning stages yet. We're just starting that, really. And so we want to see over the course of the next 12 months, 24 months, is the money supply growth persistent and persistent enough as it gets through the economy to really create some inflation that's well ahead of global economic growth. Right now, that's just not even really on the table. What we have is just a resumption to inflation levels that were already low, and I think will continue to be low, but were more normal just as we started, let's say, back in January.
And for views on current events in the world of investing, visit marketminder.com. Updated daily, it offers on-demand access to Fisher Investments' most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.